when I'm estimating my returns, what should I expect over the next 30 years? And questionnaire makes the point that Vanguard's forecasts are much lower than the assumptions often made by people providing financial. Yeah, not sure about that second piece, but part of the problem here is not so much the absolute value of the return, but how variable it is. So any forecast that's based on a fixed return is going to be generally optimistic. So if you take the view that the ASX 200 has delivered on average 13% a year, that is, if you take the 120 results for calendar year starting in 1900, 122, and take the average, you get to 13%. But an investor investing on the 1st of January 1900 would have realised 10%. And that's because they move around. The variability is very high. So 25% of those years have been negative, and probably the same percentage have been above 16%. It may have averaged 13, but there's actually only 1 year where the return actually began with a 13. So it's the variability that matters. And so you should be looking at a probability-based return. If you're looking at a high growth or growth portfolio, high growth, 9 maybe, with a 10 or 11% volatility, and then you step down to, at a 50 portfolio, you might get down to 6% with a 3% volatility. So you do have to look at those two factors in conjunction with each other. But if you're putting in 13% and invest in your assumptions and investing in a 70% growth portfolio, you're going to be sadly disappointed in due course. And keep in mind, so if I look at the US stock, my VTS has done an average of, probably has delivered 13-14% over the last 10 years. It's done really well over the last 3. 5 doesn't look quite so good. But I think if you're planning a future based on anything in double digits, unless you've got a 13, 14, 15% volatility associated with that, you are going to be disappointed. Is there a reason why the next 10 years should be, or next 30 should be worse than the last 30? There's probably a very strong argument that certainly the last 20 years have been a historical anomaly. And generally the period since the breaking of the back of inflation, so if you take from, say, just after the 90s, early 90s recession, that has been an extraordinary good period. Through the 2000s, you've had what's called the Bernanke put, where the US in particular and central banks generally have pumped money into the economy whenever anything looked a bit scary, and certainly post-GFC. So I think there's a strong argument that the last 20 years is an anomaly, and we shouldn't be expecting that to happen all the time. But having said it, should we be expecting a 1969, which was the beginning of the worst 30 years in history, worse than 1929? And the reason why it was so bad, so a retiree who retired in 1969 did worse than any other year in history since 1900. And that's because we had very low returns through the 70s, stagflation, the oil crisis, the depression, the recession of 74 and 82, and we also had high inflation. So the year I graduated in 1983, and that year we had 17% inflation, 13% interest rates, and 25% unemployment. So we haven't seen those sort of numbers in a very long time. And So that would be indicative that the last 20 years is a bit of historical anomaly. The other thing that's worth keeping in mind too, that there's a thing called the CAPE index, which is the cyclically adjusted price to equity ratio, which tries to look at price to earnings multiples adjusted for where we are in the business cycle, and that is at abnormally high values today, and that's often a precursor to lower future returns. So that's a very long way around saying, what number should I be plugging in? I'd be fairly comfortable with something beginning with 9 for a high growth portfolio, but I would want to be including a 10, 12, 13% volatility number with that.